Welcome to Iron Financial. We don't just follow the market, we put it on the anvil. We're here to help you forge a stronger portfolio, and we do that by taking a hammer to the weakest links. Today's subject, Pinterest. They just dropped their earnings, and what followed wasn't just a dip, it was a controlled demolition. Our job is to sift through that rubble and see what's left.
Oh yeah, a demolition is right. I mean, you read the press release, and it's a work of art. They're painting this masterpiece of record revenue, all-time high user counts. It's supposed to be this thriving, unstoppable platform. But then you glance over at the stock chart, and you're not seeing a masterpiece, you're seeing a horror story. It's all panic and a massive, massive sell-off.
And that's the tell. When a company's story and the market's reaction are this far apart, that's a structural fault line. Our entire mission here is to forge a path right through the PR spin and the market panic, to give you the unvarnished truth. So, is Pinterest's framework actually sound, or is this thing about to snap in half?
All right, here's our blueprint for today's analysis. First up, we're going to assess the immediate damage, the market carnage. After that, we'll actually build the bull case. We use the company's own numbers to construct the strongest possible argument for their foundation of record growth. Right, and once we've built it all up, we're going to start looking for the cracks. That starts with the Q4 miss that clearly sent investors running for the hills. From there, we're popping the hood to really dissect those key user metrics. Then it's time for the real stress test, the financials. Is this thing a fortress, or is it just a pretty facade? And finally, we'll deliver the verdict. After weighing all the evidence, we'll figure out if this huge sell-off is a real buying opportunity or if it's just a classic value trap. Let's get to work.
Okay, let's dive right in. Section 1, Market Carnage. This is all about the market's reaction, which was, brutal, immediate, and totally unforgiving. This wasn't some slow bleed over a few days. This was a sudden shock to the entire system. 19% down in after-hours trading. That's the verdict from the big institutions, delivered in milliseconds by their algorithms and traders. They didn't just sell, they hit that button with extreme prejudice. Let's really put that into perspective for a second. A 19% haircut means that nearly 1/5 of the company's entire value was just poof, vaporized in a matter of hours. This isn't just a bad day at the office. This is a full-blown crisis of confidence. The market took one look at that report and screamed, in no uncertain terms, that the future is not what Pinterest is trying to sell them. This is a 5-alarm fire on Wall Street, plain and simple. And that, of course, leads us to the billion-dollar question. I mean, if you just skimmed the headlines from their press release, you'd be forgiven for thinking the stock went to the moon. Record growth, record users. So why the total collapse? What did the smart money on Wall Street see that the average investor might have just glossed over?
This is the entire puzzle we need to solve. On the surface, it's a picture of perfect health, but the market's violent reaction tells you there's a serious sickness hiding just beneath the surface. Our job now is to diagnose it.
Right. To understand the weakness, we first have to fully understand the perceived strength. So, Section 2, the foundation. We are going to build the bull case for Pinterest using their own data. Let's actually construct the argument that this company is a fortress, just like their PR team wants everyone to believe. So pillar number 1 for the bulls, $4.2 billion in full year 2025 revenue. Look, this isn't some niche player. This is a major force in the digital advertising space. A number this big is designed to scream stability and scale. And it's meant to, for sure. This is the cornerstone of the whole bull argument, a multi-billion-dollar revenue machine that, on its face, appears fundamentally strong. It's supposed to tell you this isn't some speculative startup, it's an established business with a huge, huge footprint.
Pillar number 2 is all about momentum. 16% year-over-year revenue growth. Now, for a company that's already operating at a $4 billion scale, adding another 16%, well, that's some heavy lifting. This signals a healthy, expanding enterprise. Yep, and this is the number that's supposed to hook the growth investors. It's not just saying the machine is big, it's saying it's getting bigger at a really impressive clip. In a tough economic environment, seeing double-digit growth at this scale is meant to be a sign of resilience and serious market power.
And the third and final pillar of the bull case, 619 million global monthly active users. That's an all-time high, up 12% from the year before. In this business, your user base is your core asset, period.
Exactly. The platform appears more relevant and more engaging than it's ever been. So let's just summarize the case they presented to the market, right? Record revenue, healthy growth, more users than ever before. On paper, it's a fortress.
And there you have it, the fortress they built for Wall Street.
Record revenue, strong growth, record users. By all accounts, it looks totally impenetrable. So I have to ask the question again, why did the market bring out the wrecking ball? If this foundation is so solid, what could possibly justify a 19% collapse?
Because every fortress, no matter how strong it looks, has a weak point, and the market is exceptionally good at finding it. It's time to stop admiring the architecture and start looking for the cracks.
And that brings us right to section 3, the cracks. This is where the whole story takes a sharp turn. We're going to zoom in on the specific numbers from the fourth quarter that stopped the bulls dead in their tracks and gave the bears all the ammunition they could ever want. This, my friends, is where the facade starts to crumble. Okay, the first crack shows up right here in the Q4 numbers. Now, on the surface, these misses look tiny. They were a few million short on revenue, and they missed adjusted earnings per share by a single penny. And you might look at that and think, who cares? That's a rounding error. But in a market that is priced for absolute perfection, you would be dead wrong. Any miss, I don't care how small, is a sign of weakness. It tells the street that the company's execution is starting to falter, or maybe that their momentum is slowing down way faster than management thought. This wasn't the earthquake, but it was definitely the first tremor.
But that Q4 miss wasn't even the main event. The real damage, the thing that caused the demolition, was in the forward-looking guidance for Q1. The market is always looking ahead, and what Pinterest signaled about its future is what truly broke this stock.
Wall Street was expecting almost $982 million. Pinterest came out and guided for a midpoint of $961 million. Now, a 2% miss on guidance might not sound like the end of the world, but in the high-stakes world of high-growth tech, it's a catastrophic failure. It forces every single analyst on the street to slash their models and call the entire growth narrative into question. This is the crack that just became a chasm.
So what was the CEO's explanation for this pretty dramatic slowdown? Well, you get this masterpiece of corporate jargon. Let me translate this for you. Dynamic environment means headwinds are hitting us way harder than we expected. Laser-focused on execution is what you say right after you've just failed to execute. And my personal favorite, transforming our sales efforts, just means our current sales strategy isn't working and we are scrambling to figure out a new one.
Exactly. Vague statements like this don't inspire confidence. They just amplify fear. It sounds reactive, not proactive. It suggests that management was caught completely off guard, and for investors, that is a major red flag.
So, the weak guidance was the what. Now we need to understand the why. And the answer to that lies deeper inside the user metrics. Let's move to section 4, under the hood.
The headline number boasted a record 619 million users. That sounds great, but the crucial question for any serious analyst is this: is all growth created equal? We're about to find out.
Okay, look closely at this table. It breaks down their monthly active users and, more importantly, their average revenue per user, or ARPU, by region. In the US and Canada, which is by far their most valuable market, user growth was sluggish, just 4%. Europe was a respectable 9%. But look at the rest of the world segment. It exploded with 16% user growth. This is where that big headline number came from.
And on the surface, hey, that looks great. More users is good, right? But now I want you to look at that last column, the ARPU. This is the number that exposes the entire flaw in their growth story.
This chart lays the whole monetization problem bare. In the US and Canada, Pinterest makes $9.41 for every user. In Europe, it drops off a cliff to $1.59. But in the rest of world, the region with all the explosive growth, they make a paltry 27 cents per user. Let's just do the math on that. A single user in the US is worth 34 times more than a new user in their fastest-growing segment. This isn't some small difference. This is a fundamental, crippling flaw in their business model's expansion.
Which, of course, brings us to this critical question. Is Pinterest just adding empty calories? I mean, they can brag about massive user growth all day long, but if those new users generate almost no revenue, what is the actual value here? It's kind of like a restaurant celebrating record foot traffic because they're giving away free glasses of water. It looks good on a chart, but it doesn't actually strengthen the business. This is the core weakness that the market seized on. The growth is coming from the least valuable geographies, which means the overall quality of their user base is actually declining. They are growing bigger, but they are absolutely not growing stronger.
So now that we understand the user quality problem, we need to examine the company's core financial structure. Let's move to section 5, financials, fortress or facade. Yeah, we've seen the cracks in the growth story for sure. But is the financial foundation itself built on solid rock, or is it just sand? We're about to put their balance sheet and their profitability metrics to the test.
First, let's be fair and acknowledge the bull case on the financials. Because on paper, there are real signs of structural strength here. A gross margin of nearly 80% is elite. It means their core business is incredibly profitable. And their balance sheet is a rock. A debt-to-equity ratio of 0.04 means they have virtually no debt. A current ratio over 8 signals immense liquidity.
And the diagnostic scores look fantastic too. An Allman Z-score of 12.49 means bankruptcy risk is practically zero. A Piotrowski F-score of 8 out of 9 suggests very healthy and improving operations. Honestly, if you only looked at this slide, you'd think this company was an absolutely impenetrable financial fortress.
But that fortress has some serious issues. That really impressive 80% gross margin gets whittled all the way down to a very modest 6.9% operating margin. After you factor in R&D, sales, and marketing, there just isn't much left. And what's even more concerning to me is the Benish M-score of 1.49. This is a forensic accounting model that's designed to flag the probability of earnings manipulation. A score this high is a serious warning sign. Now, it doesn't prove there's fraud, but it does suggest the company might be using aggressive accounting to make its numbers look better than they are. And then, maybe the most telling crack of all, insider activity. In the last 3 months, 5 insiders have sold shares. The people who know the company best are reducing their exposure. That is never, ever a vote of confidence.
So what we have is a powerful contradiction. On one hand, you've got a fortress-like balance sheet. On the other, a broken growth narrative with some very concerning red flags. This brings us to our final section, the verdict.
So is the 19% drop a massive overreaction and therefore a buying opportunity? Or is it a trap, just luring in value investors before the floor completely gives way? It's time to weigh the evidence.
Okay, the bull case is pretty straightforward. You've got record annual revenue and user growth, an incredibly strong balance sheet with almost no debt and huge amounts of liquidity. And, hey, after this massive sell-off, the stock looks cheap on traditional metrics like price to earnings and price to sales. But that bear case is potent. They missed on both the top and the bottom lines in Q4. Their Q1 guidance was nothing short of a disaster, signaling a sharp slowdown. Their impressive user growth is basically empty calorie growth from regions they can't effectively make money from. And to top it all off, you've got potential accounting red flags and insiders who are heading for the exits. That's a compelling list of problems.
So, what's the final verdict here? Is Pinterest a company with a solid financial foundation that's just been put on a temporary sale by a very panicky market? Or is this a classic value trap, a structure that looks sturdy from a distance but is actually quietly crumbling from within? The headline numbers, they tell one story, but the guidance, the quality of that growth, and the moves the insiders are making, well, they tell a very different one. At Iron Financial, we don't tell you what to buy. We provide the structural analysis so you can make the tough calls for yourself. And the question you have to answer now is whether you believe in the beautiful facade or in the cracks that are now clearly showing in the foundation.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.